So I will spend a little time on explaining how investments in GLD and SLV are not only risky investments, but also how ETF investors are empowering gold and silver price suppression.
Well, that's amazing, Andrew. Now, since our last episode, we've had several of our community members that are very concerned with their GLD investments, and they're being used as a flywheel to tamp down the price of gold. Not only do these subscribers and community members not want to be part of the problem, but they're very concerned, and rightfully so, about what? About their integrity of the ETF, of their gold and silver investments, especially as you raise the issue of counterparty risk almost every single week. And can you walk us through how it's possible the bar lists that they see on the GLD website appear to be compromised?
Yeah, Shane, really good question, timely too. I think especially important to look at now when, if not, not if the next black swan event hits a broken banking sector. You need to know you've got physical when something like that happens. This time, the tail risks looming over the too big to fail authorized participants who are responsible for creating and withdrawing the trust's share baskets may not be able to get bailed out again as they were by the skin of their teeth when the related COMEX spot EFT mechanism fractured back in March 2020. Now, I really think we need to lay this ETF confusion to bed once and for all. So I will spend a little time on explaining how investments in GLD and SLV are not only risky investments, but also how ETF investors are empowering gold and silver price suppression and are almost certain to be settled for cash on their positions ahead of an inevitable gold price reset. So likely these things, as we've said multiple times, if something like that happens, it'll probably happen on a Friday with the reset coming on a Monday. Guess who's going to be left in the sidelines? So Shane, these are some very timely questions, and thanks for referring to the published bar list that attests to each of these numbered bars that have been independently audited. Now, these bars do exist, and indeed, that is sufficient to provide superficial comfort to GLD investors. But unless one digs under the covers a little, the underlying counterparty risks associated with the physical gold held in the trust are just simply not realized. And after my recent public assertions that GLD is not Basel III compliant, NSFR compliant, and does act as a flywheel to cap gold prices, I will answer these recent subscriber questions, which mirror very similar questions last week from two separate well-known institutional client subscribers who, for the first time, began questioning the integrity of this published GLD ETF bar list that provides comfort to this ETF that they're invested in. Now, while viewing this episode, I really suggest you pull up a bar list. This bar list is publicly available and it's published daily, and you can pull it, easy to pull up. And the first question, it looks very comforting. The first question arose when a client who still has a very large investment in GLD was refused physical delivery and offered cash settlement by the originating authorized participant. And this was benchmarked at the Thursday, 21st July PM fix, which came through at a 1705.10. What turned out was physical gold was not, and I repeat, not available at anywhere close to this price, despite GLD being synced at the PM fix. Yet into this basket redemption request, GLD remained static, evidencing no outflows that day, while the iShares evidenced an outflow of 3.4 tons that day. And obviously that raises questions. And so on my advice, the client redeemed his GLD shares for cash and has since then EFT directly into spot and has now taken physical delivery at a substantial premium. He wanted out. And I think we're going to see a lot more wanting out. And here's where the problem lays. And as we know, the on and off ramps for the GLD ETF flow in and out in the form of unallocated gold, with the counterparty risk transiting through the books of the authorized participant, of which there are a few. However, while an inflow into GLD escapes Basel III NSFR regulations, outflows landing on the liquidity provider's books must be NSFR compliant and must be physically backed. And therein lays the problem. And while there is little doubt that the audited GLD bar list is genuine, what is little appreciated is that the individually numbered 400-ounce bars identified on the bar list can be short sold by an authorized participant, and in other words, double counted, or in other words, rehypothecated. And given the on and off ramps into and out of the GLD ETF consist of unallocated gold, with the counterparty risk laying on the authorized participant's balance sheet at any point in time, the degree of rehypothecation is simply unknown. A black swan event, such as a plausible directly related OCC derivative blow up triggered by a serious geopolitical escalation, could expose GLD investors to unknown counterparty risk. And if you think those black swan events are not round the corner, we saw today China talking about a no-fly zone because of Pelosi thinking about flying into Taiwan. These things, we are at the edge of a very serious escalation in Russia and China. Now, while the over-the-counter FX gold market is now Basel III NSFR compliant, and if called upon for T+2 delivery, the gold credit positions must be physically backed. And there's sufficient provenance, which we'll look at in a minute, to indicate that gold credit positions diverted by authorized participants into GLD are not necessarily backed one-to-one with an equal backing of physical gold. In other words, not Basel III compliant. So COMEX-centric EFPs allow unbacked leveraged COMEX positions to be directly exchanged for a like quantity of GLD's shares. And aside from the ability to short against GLD, this leverage exchangeability for bars sitting on the GLD bar list adds another layer of opaqueness to how many ownership claims exist against each bar. Now, the problem lays in that the trust does not differentiate or segregate the counterparty risk of the unallocated gold credit positions laying on the balance sheet of the too big to fail authorized participants. The proof is in the pudding. The latest GLD SEC filings stated that the trust can refuse delivery requests. And if you remember, we read it out last time, if they said, if delivery is impractical for any reason, end quote. I mean, what they mean is if physical delivery is impractical. So this beggars the question, why? If over-the-counter FX long positions are supposed to be physically backed, and these FX gold positions flow into the GLD ETF, why would the trust need any delivery disclaimers when the bar list is supposed to back up every deposit? This underscores that the GLD ETF is not always Basel III compliant, which is why we refer to this ETF as a backdoor, non-NSFR compliant flywheel. And since GLD inventory can be short sold, is why GLD's custody does not meet industry standards and requires such a disclaimer.